Dividend stocks are boring until you realize some investors have been quietly getting paid every single quarter for decades without selling a single share. We're talking about a strategy so old and so simple that Wall Street barely talks about it because there's almost no drama to sell you. Let's back up though, because the story of dividend investing didn't start in some hedge fund. It started with the idea that owning a piece of a real profitable business should actually pay you something. Think of it like renting out a house. The property might go up or down in value, but if the tenant keeps writing checks, you're building something real. Now here's where the mood shifts. Because 2022 reminded everyone that even the most boring dividend portfolios can bleed when rates rise and the market reprices everything in sight. Stocks that look like safe havens suddenly drop 20, 30, even 40%, and a lot of new dividend investors panicked and sold the very assets that were still writing them checks. That psychological gut punch is exactly what separates successful dividend investors from everyone else. As the legendary John Bogle once put it, the stock market is a giant distraction from the business of investing, and dividend investors who stayed the course during that sell-off collected their income and bought more shares at a discount. Here's the wild irony though. The companies slashing dividends got all the headlines, while the ones quietly raising payouts for the 37th consecutive year got almost no airtime. We're wired to chase noise, and dividend investing is almost aggressively quiet by design. Historically, dividends have accounted for roughly 40% of the total return of the S&P 500 going back to 1960, a number that almost no one quotes at a dinner party, but that every serious long-term investor should have tattooed somewhere. The compounding effect of reinvesting those payments creates what some analysts call a snowball, and others call the most underrated wealth machine in public markets. And yet every cycle brings a new wave of people who dismiss dividends as a relic. Why collect 3% when growth stocks were up 200% in 2020? Only to find themselves exposed when the music stops. We've seen this story in 2001, 2008, and 2022. And somehow, each time it surprises people. Let's clear up the biggest misconception right now. A high dividend yield is not automatically a good thing. Because sometimes it's the market screaming that a cut is coming. A company yielding 9 or 10% in a low-rate environment is often a trap, not a treasure. Discipline means skipping those and focusing on companies with low payout ratios, strong cash flow, and a track record of growth. The practical playbook here isn't complicated, but it requires you to be emotionally boring on purpose. Focus on dividend growth rate, overall yield, diversify across sectors, reinvest automatically, and never let conviction in a single name push you into an oversized position. Position sizing is everything, because even a company like General Electric, once the gold standard of American dividends, cut its payout to 1 cent in 2018 and shattered portfolios that were over-concentrated. The lesson isn't that dividends are unreliable. The lesson is that no single stock deserves to be your entire plan. The philosophical truth underneath all of this is that dividend investing rewards patience in a culture that worships speed, and that's precisely why so few people actually stick with it long enough to feel the compounding take hold. It's not glamorous, it doesn't trend on social media, and it will never give you a story about turning $500 into $5 million in 18 months. But here's what it will give you: a systematic, repeatable process that pays you while you sleep, that grows during expansions, and that, if you've built it right, holds up better than most strategies when things get ugly. The discipline of buying quality, sizing positions responsibly, and reinvesting consistently is less a strategy and more a philosophy about how wealth actually accumulates. And honestly, whether markets cooperate this year or spend 12 months testing your nerves, a well-constructed dividend portfolio leaves you comfortable with either outcome, because the income keeps arriving regardless of what the ticker says on any given Tuesday. That's not passive optimism. That's rational preparation built into the architecture of the strategy itself. At the end of the day, the investors who win with dividends aren't the ones who picked the highest yields or timed the market perfectly. They're the ones who showed up consistently, sized their bets humbly, and let time do the heavy lifting. Boring wins slowly, And that's the whole point. If you're ready to start building real wealth, whether through dividend investing, real estate investing, home contracting work, or finding the right lenders, check out our links in the description below and let's get you started.